Okay, let's just jump right in with a number that honestly kind of blew my mind. $28 trillion. That is the volume of stablecoins moved in just the first quarter of 2026 alone. To put that into perspective, that's a 51% jump from the previous quarter. And it's actually more volume than Visa and MasterCard processed in 3 months combined. So what does this tell us? Well, it proves that crypto is no longer just some niche internet experiment, and it's definitely not just a playground for speculation anymore. It has quietly morphed into a massive, functioning global economy, actively moving digital dollars across borders and settling business invoices at a scale that is literally impossible to ignore.
Welcome. I am absolutely thrilled to guide you through this explainer today. Now, I know the crypto space can feel like this crazy maze of complex technical jargon, wild price swings, and honestly, pretty confusing headlines. But together, we're going to strip all of that away. We're going to uncover what cryptocurrency actually is, how the underlying technology works, and most importantly, why it matters to you. So, whether you're completely new to the space or you're just looking to solidify your understanding, you are definitely in the right place.
Here is our roadmap for today. 1. Origins of the crypto revolution. 2. How the blockchain actually works. 3. Real-world uses and adoption. 4. Investing, risks versus rewards. And finally, number 5, the future of digital money.
All right, let's kick things off with Section 1, Origins of the Crypto Revolution. You know, a lot of people think Bitcoin just popped out of thin air. But what's really fascinating is that the foundation for digital cash was actually laid by cryptographers decades before Bitcoin ever existed. Think back to 1996. The NSA actually published a paper on anonymous electronic cash. Then Adam Back developed Hashcash in 97, followed by Wei Dai's B-Money in 98. So the cryptographic puzzle pieces, they were already sitting right there on the table. But it took the massive shock of the 2008 global financial crisis to act as the ultimate catalyst. That's what prompted a mysterious figure, or maybe a group of people, we still don't know, named Satoshi Nakamoto to put all those pieces together and publish the famous Bitcoin white paper.
The core of this whole movement is captured perfectly in Satoshi Nakamoto's foundational vision. He wrote, "What is needed is an electronic payment system based on cryptographic proof instead of trust, allowing any two willing parties to transact directly with each other without the need for a trusted third party." Born right in the aftermath of massive bank bailouts, the idealistic desire here was to completely eliminate the inefficiencies of the traditional banking system. Nakamoto realized that relying on central banks to mediate our money was a massive bottleneck. By replacing human trust with cold, hard cryptographic proof, any two people on Earth could finally transact directly with each other. The middleman? Completely gone.
Moving on to Section 2, how the blockchain actually works.
Okay, so that all sounds incredible in theory, right? But how exactly do we achieve a decentralized, trustless system without it instantly turning into absolute chaos? The answer is the blockchain. I want you to think of it like a giant shared notebook in a room of 100 people. If you want to send money to someone, you announce it to the room and everyone writes it down in their notebook at the exact same time. Now, if a malicious actor tries to sneakily alter a transaction in their specific book to give themselves more money, it doesn't work. The rest of the network instantly compares their notebooks, spots the mismatch, and immediately rejects the fraud. There is no central server to hack here. The security comes entirely from the decentralized consensus of the group.
So here is how that exact process plays out in action. Someone requests a transaction, and it gets broadcasted out to a massive peer-to-peer network of computers, which we call nodes. These nodes then use complex cryptographic algorithms to verify the transaction. Once the network reaches consensus that yes, this transaction is valid, it's combined with a bunch of other transactions to create a brand new block of data. And then this new block is permanently, unalterably locked onto the existing chain. As long as the software keeps running, that ledger is secure, transparent, and completely immutable. No takebacks.
Let's dive into Section 3, Real-World Uses and Adoption.
Let's shift gears to the present day and see how this technology translates into real-world utility, way beyond just people trading tokens on their phones. A really crucial point to understand is where adoption is actually happening. It's not necessarily being driven by Wall Street. Developing nations like Turkey, Brazil, Colombia, and Argentina, they are aggressively leading global crypto adoption. Why is that? Well, in regions where local currencies are getting crushed by severe inflation or where the traditional banking system just plain fails its citizens, cryptocurrency is acting as a vital defense mechanism. It's essentially a digital lifeboat, helping to bank the unbanked and allowing businesses to survive and thrive across borders with super low fees.
And then we have decentralized finance, or DeFi for short, which is entirely revolutionizing how we handle our assets. By utilizing self-executing smart contracts, which, by the way, are really just simple programs that automatically enforce agreements the second certain conditions are met, DeFi completely replicates traditional financial services, but zero middlemen are involved. You can lend your crypto out to earn interest, trade directly peer-to-peer on decentralized exchanges, or lock up your tokens to help support the network and earn passive rewards. It's basically a totally open-source financial utility, and it's available to literally anyone with an internet connection.
Which brings us to Section 4, Investing, Risks versus Rewards.
Okay, before we get too swept up in the amazing potential here, it is absolutely time for a reality check about operating in this digital Wild West. We need to ground ourselves with a pretty jarring statistic: $5.8 billion. In 2024, the FBI reported that staggering amount lost purely to crypto investment fraud. It actually became the largest category of cybercrime by dollar amount. So as much as blockchain technology itself is incredibly secure by design, the human ecosystem built around it requires extreme caution, because scammers are highly active and, frankly, they are incredibly sophisticated.
This right here is the ultimate trade-off of the crypto space. Whenever we talk about the immense rewards of becoming your own bank, gaining true financial autonomy, earning those high yields, having actual unmediated ownership of your assets, we have to immediately pair it with the severe risks. There is no central bank safety net backing you up here. If a smart contract gets hacked, or if you simply lose your private key or your seed phrase, your money is gone. Forever. There is no customer service hotline you can call up to reverse a transaction or reset your password. You are entirely on your own.
Because of this, you absolutely have to watch out for the common traps. One major mistake people make is trusting fake investment dashboards that promise guaranteed unrealistic returns. Think about it. If a platform controls the interface you're looking at, they can fabricate any number they want on your screen. You also have to be hyper-vigilant against phishing attacks hiding malicious wallet trainer links and rug pulls, which is where developers hype up a project, gather funds, and then just abandon it and run off with the money. And please remember, buying meme coins that have zero actual utility just because you hope to sell them to a greater fool later on, that's incredibly dangerous speculation. It is not investing.
A really big problem users face is what we call the illusion of security. Do not assume your funds are completely safe just because the blockchain itself is cryptographically secure. Hot wallets, the ones connected to the internet on your phone or browser, they're highly vulnerable to modern malware that can easily intercept your passwords. Now, cold hardware wallets are highly recommended and they're definitely much safer, but they still carry operational risks. At the end of the day, the human factor, like mismanaging your passwords, accidentally clicking the wrong link, or foolishly storing your seed phrase digitally, that remains the absolute weakest link in the entire chain.
And that brings us to our final section, Section 5, the future of digital money.
Despite all of those very real risks we just talked about, institutional involvement from massive banks and asset managers has fully crossed the point of reversibility. They're in. So let's look at what's coming next. Fast forward to 2030 or 2035, and the forecast suggests we're going to see incredibly futuristic applications happening totally invisibly in the background. We're talking about the Internet of Things, where autonomous machines execute fractions of a cent micropayments. Imagine your electric car automatically paying a charging station in real time, second by second. We'll likely see AI agents managing their own digital wallets, and the tokenization of real-world assets, which would let you easily buy a tiny fraction of a commercial high-rise or a piece of fine art on the blockchain, all of it supported by highly regulated custody environments.
I want to leave you with this final provocative thought. We are living through a fundamental paradigm shift in how humanity defines, stores, and transfers value. As this ecosystem matures, scales up to handle trillions of dollars effortlessly, and empowers billions of people with direct control over their finances, how exactly is the old financial guard going to survive? Will traditional banks successfully adapt and integrate these decentralized technologies, or are they ultimately going to be left behind by the very revolution they once dismissed? Thank you so much for joining me for this explainer, and keep learning.